Twitter joins the cryptocurrency revolution. iPhone users may now tip using Bitcoin. Twitter is also keeping an eye on NFTs. Adoption of cryptocurrency is accelerating, and Twitter is the latest corporation to hop on the digital asset bandwagon. The social media behemoth is introducing a new tool that allows users to tip their favorite accounts using a variety of payment methods, including Bitcoin. Twitter is also pursuing non-fungible tokens, NFTs, which comes as no surprise. Twitter is teaming with NFT investors who enjoy flaunting their absurdly costly NFT-based CryptoPunk avatars, thus it was only a matter of time before the social media platform delved headfirst into NFTs. Twitter now offers Bitcoin advice to iOS users. According to the social media giant's most recent blog post, account holders will be able to tip using Bitcoin via Strike, a payments app built on the Bitcoin Lightning Network. The software enables users to send and receive Bitcoin instantaneously and for free globally. Individuals in qualifying markets must create a Strike account and add their Strike username in order to get Bitcoin tips via the Lightning Network. You may send tips to someone's Strike account using any Bitcoin Lightning wallet. Esther Crawford, Twitter's product manager, stated. Strike is accessible in El Salvador and the United States, except for New York and Hawaii. The service is first available on iOS, while Android users will gain access to Twitter's Bitcoin tipping option in the coming weeks. Twitter, according to TechCrunch, is also considering allowing creators to promote their NFTs on the social media platform. The company is actively experimenting with strategies to differentiate NFT developers from the competition, for example profile badges and differently shaped avatars. However, because Twitter's NFT initiative is still in its infancy, the social media giant declined to expand more and contacted. Twitter is not the only social media platform that has dabbled in cryptocurrencies. Facebook stated at the end of August that it is preparing to launch the Novi digital wallet. It will debut its new blockchain-based payment system using a stablecoin called DM, a cryptocurrency that is pegged to the value of the US dollar, for example 100 DM equals $100. As cryptocurrencies gain widespread acceptance, it will be fascinating to see how digital behemoths incorporate them into their systems. Ultimately, only time will tell. BUSD, a stablecoin compliance and security case study. Stablecoins have established themselves as key players in the cryptocurrency market this year, owing to customer need for flexible liquidity during fiat currency periods. These currencies are characterized as a sort of digital currency that is pegged to or supported by underlying physical assets. These assets could be fiat money, precious metals such as gold or silver, or even another cryptocurrency. Stablecoins, as its name implies, are supposed to have a value that is relatively stable, similar to cash, in contrast to the volatility prevalent in cryptocurrency trading today. To explain this scenario further, consider a typical fiat-backed stablecoin in which the token issuer holds 100,000 tokens worth $1 each. Token holders can trade their currencies in the same way as they would with any other cryptocurrency. The primary distinction is that the holder may also redeem the coins at any moment for a comparable amount of USD. Because the USD is very steady, customers need not fear that their money may lose value overnight. As a result, CoinMarketCap estimates that stablecoins are currently valued $120 billion. While stablecoins have increased in popularity as a way to mitigate volatility, several areas of the cryptocurrency industry have raised concerns about their centralized structure. Given the issuer's inability to establish the volume of backing funds, a one-to-one peg of major stablecoins to their underlying assets, such as the US dollar and other fiat currencies, may be meaningless, particularly in the absence of effective regulation. Nonetheless, their promise is clear in a variety of common applications. Binance launched BUSD with Paxos in 2019 to demonstrate their use. A primary motivation for this release was to ensure that each stablecoin unit was verifiably backed by US dollars and adhered to regulatory and public norms. A matter of reserves. To provide customers with peace of mind and to lend greater legitimacy to inquiries concerning reserves, BUSD's USD assets are held in FDIC-insured banks. According to Paxos Reserve Report, 96% of the BUSD's entire market capitalization is backed by cash and other cash equivalents, while 4% is guaranteed by US Treasury bills. To bolster confidence in these figures, BUSD is one of the few stablecoins that publishes a monthly audited report on its reserves. As a result, each BUSD holder can check at any moment that the supply of BUSD tokens is consistent with the USD that Paxos holds and manages. Combining audits and extra methods to verify BUSD's asset holdings is becoming increasingly critical in solving one of the industry's primary challenges today: keeping compliance. The second key worry with stablecoins today is the current regulatory vacuum, which many say provides insufficient investor protection, particularly with regard to fraudulent activity. To address this, BUSD continues to adhere to the New York State Department of Financial Services Strictest Compliance Standards, NYDFS. Due to the presence of a regulator, BUSD has been green-listed by regulatory authorities, indicating that it has been pre-approved for custody and trading by current virtual currency licensees. Paxos, the issuer of their stablecoin, is likewise controlled by the same agency, which ensures the following. Each stablecoin token's value is directly linked to the US dollar, and the amount of reserve cash is at least equal to the total number of stablecoins in circulation. Regulators are in charge of establishing and maintaining stablecoin reserves. Reserves are stored in the safest possible asset classes, i.e., treasury bills, insured bank accounts. In accordance with New York banking law, reserves are totally segregated from business assets and maintained in a bankruptcy remote location. This amount of regulatory control enables consumers to maintain confidence in an asset that operates in a mostly unregulated industry. Stablecoins in action. In the correct circumstances, stablecoins offer significant advantages over traditional cryptocurrencies. These frequently include minimizing market volatility, managing recurring transactions, and laying the groundwork for decentralized finance, DeFi. Market instability management. Cryptocurrency prices have a history of wildly fluctuating in response to public opinion or private company choices. Traders may then choose to exchange their declining cryptocurrency for an asset or a fiat-backed stablecoin in order to preserve the value of their digital currency holdings. Investors might mitigate risk by storing their assets in a more solid investment vehicle. Transactions that occur daily. Stablecoins, like other fiat currencies, can be used for everyday transactions such as purchasing coffee or sending money to a family member who lives abroad. Fees may be cheaper than those associated with financial transactions, occur more rapidly, and ensure that the receiver receives a fair value for the trade. Constructing DeFi foundations. Finally, stablecoins are critical in ensuring the continuous expansion of decentralization by laying the groundwork. BUSD is utilized on the Binance Smart Chain, BSC, and Ethereum, ETH, for a variety of purposes, one of which is lending. Users can over-collateralize an existing digital asset with stablecoins in the loan setting to assure a continuous market price, hence avoiding any swings caused by the underlying collateral. Loans are just one example of how stablecoins can provide the stability required for the blockchain to continue expanding as an infrastructure and cryptocurrencies to assume the function of traditional money as a medium of exchange. Pursuing conformity. With an increase in stablecoin use cases, many fear that the financial industry would suffer if corporations do not address these concerns. As a result of these factors, the USD continues to place a premium on compliance. This can help preserve users' and regulators' faith in stablecoins while also expanding potential for both the public and private sectors. Many believe that when more stakeholders demonstrate approval for trusted stablecoins, development prospects will follow shortly behind. Binance CEO Changpeng CZ Zhao stated during a recent virtual press conference, "Our opinion is that regulators stepping in is a good thing. To achieve 10%, 20%, 80%, or 95% crypto adoption." Afghanistan's growing cryptocurrency economy teaches us a valuable lesson. Afghanistan has recently descended into chaos and conflict, causing its wealthy inhabitants to turn to cryptocurrencies as a means of keeping and transferring cash. The more prosperous Afghans have always stored their wealth in paper money or gold. Occasionally, individuals send money abroad through Hawala, a network of Islamic brokers. However, the situation is evolving. Despite the country's economic and political volatility, cryptocurrency is beginning to penetrate. While the country may take some time to adopt cryptocurrencies, its development is a positive sign that the country is considering the sensitive financial problem of trust and credit. And it makes no difference whether you are a Bitcoin enthusiast or hater. Economic consequences are associated with cryptocurrency. According to Hyung Song Shin, a Princeton economics professor and the Bank for International Settlements senior economist, Bitcoin's worth and confidence are contingent on people maintaining a shared computational record of transactions. When constructing this ledger using processing power, however, you are more likely to introduce frictions or suffer significant economic expenses. Utilizing cryptocurrencies as a medium of exchange is more expensive than using other methods of payment. For instance, the United States Federal Reserve effectively and credibly issues money. It is a reputable entity. As a result, the associated costs are quite minimal. However, as the professor points out, the expenses of utilizing cryptocurrencies can appear to be less onerous than the hazards associated with dealing with a failing government, such as Afghanistan's, or, worse, attempting to obtain scarce paper money, such as dollar bills. Afghanistan must first establish a transparent central bank, a trustworthy central authority, and sound political governance before adopting cryptocurrencies. Shin continues by stating that if you live in a failing or insecure country, Bitcoin is a better option. However, you will incur a substantial cost in that case. Cryptocurrency adoption in emerging markets is a slow process. Numerous underdeveloped countries, including Vietnam, India, Kenya, Nigeria, Venezuela, and Pakistan, ranked first in a recent survey connecting crypto usage to economic activity, in 154 countries. The United States was in the top 10 developed countries in terms of GDP per capita. Regrettably, Afghanistan is not a cryptocurrency heavyweight. The findings reflect the wealthy's level of trust in the government and their ability to obtain dollar bills. Another factor contributing to Afghanistan's limited crypto adoption is the country's low internet penetration. Afghanistan is now ranked 21st in terms of cryptocurrency usage, despite these obstacles. As a result, Afghanistan's crypto economy is thriving and will likely bloom in the near future as the country's purchasing power and internet usage expand. Ethereum balances on cryptocurrency exchanges reach new lows as the price of ETH reclaims $3,000. Meanwhile, over 7.75 million ETH has been pledged in Ethereum 2.0 smart contracts. The total amount of ETH, held by all cryptocurrency exchanges reached a record low on September 23, just as its price returned to above $3,000 per unit. According to data compiled by CryptoQuant, a blockchain analytics firm, exchanges' net Ethereum token reserves have decreased to 18.533 million ETH from 23.92 million ETH a year earlier. Meanwhile, the cost of purchasing one Ether increased from approximately $349 to as much as $3,078, demonstrating an inverse relationship between ETH reserves on exchanges and pricing. Factor of supply and demand. Reduced exchange reserves indicate that traders are more likely to hold the underlying cryptocurrency rather than exchange it for other digital or fiat assets. As a result, if demand for the token increases, the absence of an appropriate supply contributes to drive up prices. Thus far, it appears as though Ethereum's native coin has begun to follow the traditional low-supply high-demand bullish scenario. For example, DApp Radar reported in August 2021 that the total value locked, TVL, throughout the decentralized applications market had reached $142 billion, with 68% of that value concentrated on the Ethereum network. On the other side, once Ethereum unveiled its staking functionality in November 2020, the network began transitioning to a full-fledged proof-of-stake blockchain by 2022. To be more specific, the TVL included under so-called Ethereum 2.0 smart contracts increased from 11,616 ETH in November 2020 to 7.75 million ETH on September 23. Additionally, on August 5, 2021, a significant network upgrade dubbed the London Hard Fork implemented a feature that slowed the growth of Ether supply. The update, known as EIP 1559, began dividing the nearly 13,000 new ETH issued daily for miner payment fees into three parts. The network began burning one of these splits, the base price charged by consumers to miners for transaction processing. As a result, additional ETH tokens became scarce. According to data tracking website watchtheburn.com, the EIP 1559 functionality has resulted in the burning of 352,262 ETH to date, or almost $1.1 billion at current exchange rates. According to Lark Davis, an independent cryptocurrency market researcher, the current supply-demand dynamics in the Ethereum market will help propel ETH values towards $10,000. The macroeconomic impact. This week, cryptocurrency markets reacted to an impending home crisis in China's property sector and its ripple effect on global economies. In summary, the ETH/USD dollar exchange rate fell 20.78% in the first 2 days of this week, reaching a low of $2,651, as investors shifted away from riskier markets and towards safe havens such as the US dollar and Treasury bonds. Fears of contagion from China Evergrande Group's debt issues spurred the sell-off. China Evergrande Group owes billions of dollars in bonds to worldwide investors. Ether recovered up to 18.82% from a local low of $2,651, including a 2.33% gain to $3,150 on Thursday. Nonetheless, the 50-day exponential moving average, EMA, near $3,191 and the 20-day EMA near $3,291 performed as strong resistance targets. According to Sentiment, a blockchain data tracking firm, the Ethereum token may continue to bounce as long as its short-term holders remain unprofitable. The portal referenced the market value to realized value, MVRV, ratio as the basis for its bullish analogy. The MVRV ratio is determined on a 7-day average. MVRV 7D is indicating a short-term recovery, but a sustained rise is unlikely until we get closer to the next major speculative event, the transfer to proof of stake, POS, in 2022. ANZ wants crypto exchange licenses to be more visible. Prior to providing banking services, ANZ Banking Group is skeptical that cryptocurrency can be safely integrated into its banking system, but it is willing to collaborate with regulators to better understand the risk. CEO Shane Elliott stated at a standing committee on economics on Thursday that the Big Four banks currently lack the framework to safely trade in the cryptocurrency space. For the time being, we are struggling to understand how we can service that area, particularly around crypto exchanges, and do so while maintaining compliance with our own obligations regarding money laundering, sanctions, anti-terrorism, financing, and so on, he said. That's not to say it's a permanent policy, but it's difficult right now. Elliott stated that, for the time being, a crypto business may apply for a license from the anti-money laundering agency Austric, but the bank has no way of knowing or getting access to that information. So it's a difficult area, he said, adding that ANZ will stick to its policy of not providing banking to the crypto exchange world in particular. However, as I previously stated, this is not an indefinite policy. It will depend on how things emerge in that space and how safely we can do so. The bank has already reported a 53% year-on-year increase in investment scams, with a high proportion of these involving cryptocurrency. Elliott stated that continued collaboration with Austric would be required for ANZ to confidently reconsider its current policy. We need to know what happens to payments, where the money goes, and what it's used for, he said. The very nature of cryptocurrency makes meeting those obligations very difficult, so we have to work with people like Austric to understand how we can facilitate that. CBA CEO Matt Comin stated at the same committee on Thursday that the bank is in regular dialogue with Austric on this particular topic. Elliott went on to say that ANZ already facilitates billions of dollars in transitions across a wide range of financial institutions every single day. As a result, it's not an area where we disagree philosophically. We just need to make sure we can operate in the space safely, he explained. How to ensure the survival of your blockchain investment portfolio during sell-offs. How does one invest successfully in cryptocurrency without succumbing to volatility? On Monday, a new wave of fear, uncertainty, and doubt, FUD, fueled by prospective regulatory crackdowns, hit the burgeoning cryptocurrency industries once again. Bitcoin, BTC, Ethereum, ETH, Cardano, ADA, and Binance Coin, BNB, all lost more than 10% of their value in a single trading day before regaining it. The majority of the approximately 12,000 cryptocurrencies available have seen harsher sell-offs. However, it is critical to remember that, despite the significant sell-off, they are still up by 5 to 6 figure percentages since inception. Thus, let us examine the best course of action for investors to take in order to safeguard their blockchain holdings. Punctuating the shrouds. Contrary to common assumption, regulatory concerns are not the primary reason for the cryptocurrency sector's harsh drawdowns. This is obvious to anyone who understands the fundamental cryptography that protects digital currencies, which encrypts data in seconds and ensures that decrypting it can take decades or millions of years. Additionally, contemporary technologies such as decentralized finance, DeFi, decentralized applications, dApps, and decentralized exchanges, DEX, run on worldwide peer-to-peer networks without the use of centralized servers. As a result, regulators and law enforcement cannot simply raid a crypto headquarters and take the servers, as there are none. Bitcoin fell nearly 12% in a single day in early 2018 when South Korea declared it would ban cryptocurrency trade. However, that prohibition was never implemented. Consider the enforcement implications. The South Korean authorities would need to confiscate residents' phones, computers, and laptops, scan them for wallets, question them about their private keys, and then manually erase them. Indeed, even an authoritarian regime like China cannot go so far as to explicitly prohibit cryptocurrency ownership. Recognize crypto cycles. As a result, regulatory concerns roughly correspond to market corrections. The genuine bear market threats originate from two sources. To begin, there is a correlation with global financial markets in general, and particularly with stock indexes such as the S&P 500. Cryptocurrencies are not designed to protect investors from asset meltdowns. Rather than that, they are significantly more volatile than equities. For instance, in March 2020, when the World Health Organization proclaimed the coronavirus a pandemic, Bitcoin and other cryptocurrencies lost 50% of their value in 2 days. Second, bear markets are caused by the internal collapse of trust within peer-to-peer networks. Indeed, the whole market capitalization of cryptocurrencies plummeted by 75% in 2018. At the time, cryptocurrency exchanges were not safe, with hackers stealing an average of $2.7 million coins each day. Additionally, scammers such as the founders of Ponzi scheme cryptocurrency BitConnect promised investors ultra-high yields and then stole their money, resulting in losses exceeding $2 billion. What am I to do? While hacker activity has decreased in recent years, the increase of DeFi fraud and the practice of developers soliciting investors' deposits and making a run with them cannot be said the same. The total value of crypto assets locked up in staking, yield farming, borrowing and lending, and liquidity farming, as defined here, has risen to $163.27 billion. Due to the fact that crypto security organizations have not reviewed the source code of all projects, there is a large number of questionable activity out there. Hacks and protocol fraud involving DeFi have increased to $474 million year to date. The next crypto boom is very certainly going to bust as a result of a big scam or massive quantities of questionable behavior, with all of this money flowing into DeFi. However, we still have several months until then. If anything, the industry's extreme volatility means that it may take as little as 1 year to complete a whole bull-bear market cycle, compared to a decade for stocks. Investors who bought at the top and are now holding losses should not fear, the next bull cycle will begin soon. Thus, the critical takeaway is to commit to a multi-year cryptocurrency acquisition strategy. For the purpose of argument, one should purchase crypto every month for the next 3 years using their disposable money, regardless of what occurs. Then investors are virtually guaranteed to capture at least one mega bullish crypto market cycle throughout that time period. Therefore, you should absolutely hold through this corrective sell-off. These are the countries where Bitcoin is restricted or illegal. Since its inception in 2009, Bitcoin has been fraught with controversy, as have the cryptocurrencies that have followed in its wake. While widely criticized for its volatility, use in illegal transactions, and exorbitant use of electricity to mine it, some, particularly in the developing world, see Bitcoin as a safe haven during economic storms. However, as more people turn to cryptocurrency as an investment or a lifeline, these issues have manifested themselves in a slew of restrictions on its use. The legal status of Bitcoin and other altcoins, alternative coins to Bitcoin, varies greatly from country to country, and in some cases, the relationship is still unclear or changing. While the majority of countries do not make the use of Bitcoin illegal, its status as a means of payment or a commodity varies, with varying regulatory implications. Some countries have imposed restrictions on how Bitcoin can be used, such as banks prohibiting their customers from transacting in cryptocurrency. Other countries have outright prohibited the use of Bitcoin and cryptocurrencies, imposing severe penalties on anyone engaging in crypto transactions. These are the countries with the most troubled relationships with Bitcoin and other cryptocurrencies. Algeria. Algeria currently prohibits the use of cryptocurrency, following the passage of a financial law in 2018 that made the purchase, sale, use, or holding of virtual currencies illegal. Bolivia. Since 2014, Bolivia has imposed a complete ban on the use of Bitcoin. The Bolivian central bank issued a resolution outlawing it, as well as any other currency that is not regulated by a country or economic zone. China. Throughout 2021, China has intensified its anti-cryptocurrency crackdown. Chinese officials have repeatedly warned their citizens to avoid the digital asset market, and they have imposed severe restrictions on mining in the country as well as currency exchanges in China and elsewhere. On August 27, Yin Yuping, Deputy Director of the People's Bank of China's (BOC) Financial Consumer Rights Protection Bureau, referred to cryptocurrencies as speculative assets and advised people to protect their pockets. Efforts to destabilize Bitcoin, a decentralized currency independent of governments and institutions, are widely interpreted as an attempt by the Chinese government to launch their own e-currency. The BOC aspires to be one of the world's first major central banks to issue its own digital currency, allowing it to more closely monitor its citizens' transactions. The BOC went even further on September 24 and outright banned cryptocurrency transactions in the country. Colombia. Financial institutions in Colombia are not permitted to facilitate Bitcoin transactions. In 2014, the Superintendents Financiera warned financial institutions against protecting, investing, brokering, or managing virtual money operations. Egypt. In 2018, Egypt's main Islamic advisory body, Dar al-Ifta, issued a religious decree labeling Bitcoin transactions as haram, which is forbidden under Islamic law. While not legally binding, Egypt's banking laws were tightened in September 2020 to prohibit the trading or promotion of cryptocurrencies without a central bank license. Indonesia. Bank Indonesia, the country's central bank, issued new regulations on January 1, 2018, prohibiting the use of cryptocurrencies, including Bitcoin, as a form of payment. Iran. Bitcoin's relationship with Iran's regime is complicated. Iran has turned to the lucrative practice of Bitcoin mining to finance imports in order to avoid the worst effects of crippling economic sanctions. While the central bank forbids the trading of cryptocurrencies mined abroad, it has encouraged Bitcoin mining in the country by providing incentives. According to blockchain analytics firm Elliptic, Iran accounts for about 4.5% of the world's Bitcoin mining, which could generate more than $1 billion, 843 million euros, in revenue. Iran has offered cheap energy to licensed miners in order for the crypto industry to thrive, but all mined cryptocurrency must be sold to the central bank. Unlicensed mining, on the other hand, drains more than 2 gigawatts from the national grid on a daily basis, causing power outages. To that end, Iranian authorities have issued a 4-month ban on Bitcoin mining, which will last until September 22. Iraq. Despite government efforts to keep them out, cryptocurrencies are becoming more popular in Iraq. The Iraqi central bank has been especially hostile, issuing a statement prohibiting their use in 2017 that is still in effect today. In early 2021, the Kurdistan Regional Government's Ministry of Interior issued a similar directive to prohibit money brokerages and exchanges from dealing in cryptocurrencies. Nepal. Bitcoin was declared illegal by the Nepal Rashtra Bank in August 2017. North Macedonia. North Macedonia is currently the only European country with an official ban on cryptocurrencies like Bitcoin, Ethereum, and others. Russia. While cryptocurrency is not illegal in Russia, it is the subject of a long-running conflict. In July 2020, Russia passed its first crypto regulation laws, which designated cryptocurrency as taxable property for the first time. The law, which took effect in January of this year, also prohibits Russian civil servants from owning any cryptocurrency. Russian President Vladimir Putin has repeatedly linked cryptocurrency to criminal activity, urging increased scrutiny of cross-border cryptocurrency transactions in particular. In July, the Prosecutor General announced new proposed legislation that would allow police to seize cryptos deemed to have been obtained illegally, citing their use in bribery. Turkey. As the value of the Turkish lira fell, many people in Turkey turned to cryptocurrency. With some of the world's highest levels of use, regulations arrived quickly this year as inflation peaked in April. The Central Bank of the Republic of Turkey issued a regulation on April 16, 2021, prohibiting the use of cryptocurrencies, including Bitcoin, to pay for goods and services, directly or indirectly. The next day, Turkish President Recep Tayyip Erdogan went even further, issuing a decree that adds cryptocurrency exchanges to a list of companies subject to anti-money laundering and terrorism financing regulations. Vietnam. The State Bank of Vietnam has declared that the issuance, supply, and use of Bitcoin and other cryptos as a means of payment are illegal and subject to fines ranging from 150 million VND, 5,600 euros, to 200 million VND, 7,445 euros. The government does not, however, prohibit Bitcoin trading or holding as an asset. We hope you enjoyed watching and listening to this video. Please let us know your opinion in the comments area below. If you found our content useful, please like it and share it with your friends. Also, don't forget to subscribe to our channel and hit the notification bell for more crypto-related contents.